Welcome back to Dukascopy TV. Today we have another collaboration interview with financial newspaper Agefi. Journalist Nicolette will be discussing credit and risk equities with CIO of Pictet & C, Yves Bonzon. Over to you, Nicolette.
Pictet's investment philosophy differs from other more mainstream strategies. Yves Bonzon, CIO of Pictet Wealth Management, bases all his allocations on risk and return. He is joining us this morning to explain us how and why he does this. Yves, good morning.
Good morning, Nicolette.
Thank you for joining us this morning. All your strategies are based on risk and return, and you view credit and defensive equities as the best investment at the moment.
Indeed, at the beginning of the year, we made a significant change in the way we allocate capital. Increasingly frustrated with the very high level of correlation between the main investable asset classes as well as within the asset classes. We have decided to take a different look at how we allocate funds. And in essence, what we do is think in terms of sources of return or risk factor-based strategies. And that leads to a portfolio which is divided up in two main categories of investment. Some strategic investment, which in our view fit the best the current structural outlook, the current secular forces at work in markets and the economy, and a tactical allocation which is a lot more flexible, and a lot more adaptable to risk on, risk off type of environment where you have to switch very quick from deflation-prone assets to inflation-prone assets.
Okay, one rather odd characteristic of your portfolio is that you have no direct exposure to emerging markets.
Exactly. We have, of course, indirect exposure through large cap developed companies, among other things. But emerging market is about debt and equity, like most markets. On the debt side, we like structurally emerging debt in local currency. But we've come to the point where probably future currency realignment between developed and mature economy is more likely to be achieved through inflation differential as opposed to forex nominal gain. And therefore, given the carry trade nature of this asset class and its high correlation to equity market, we thought that it added actually little to what we have in terms of equity exposure elsewhere in the portfolio. On the equity side, the rationale was different. There is a sort of naive belief that there is a link between growth and stock market returns. But if anything, actually, some of the slowest growth economy over the medium terms produce the highest return in the equity market. And that is essentially a function of the discipline in capital deployment and capital management. What we see in emerging market is a lot of investors dilution, share issue, new IPOs. Whereas in the Western world, where we have a sort of de-equitization phenomena, the supply-demand equation for equities is much stronger.
Okay. Now, I know Europe is not your favorite subject. It's facing daunting challenges, and you don't believe that its authorities are competent enough to repair the damage.
I don't know if the issue is competence, but it's certainly political agenda, because no politicians in Europe has a long enough term to push forward the required policy to address the crisis. So it's a matter of incentive as opposed to competence, I think. In terms of the outlook for Europe, there's a new bout of optimism, in the markets today because of this OMT program that has been announced by the ECB a couple of weeks ago. While it's a step in the right direction, and it does to some extent address the funding gap in the periphery of Europe, it's certainly not enough. And perversely, following the law of unintended consequences, it might actually give an opportunity to European politicians to actually postpone restructuring, postpone bad loan recognition, postpone banks' recapitalization. If you give the opportunity to Italians and Spanish governments to refinance at the short end of the curve at 2 or 3%, even though their economy are barely growing in nominal terms, it's all right. I mean, they can afford that. And so there are two angles to it. It's a step in the right direction, but it's also an opportunity to postpone the necessary reforms.
Okay, so let's move on to cover the rest of the world, which by now is the United States. You have spotted anecdotal evidence that US balance sheets are repairing in the form of a conjunction between the rise of the S&P 500 and the fall of gold last March, something that hasn't happened since 2003.
Correct. The rationale behind this is the following. In markets, quite often, price behavior actually reflects changing fundamentals before fundamental evidence is available to investors. And therefore, we are carefully monitoring the relationship between gold and US equities to understand if the balance sheet recession is about to finish in the United States. We have growing evidence that the housing market is improving. Not so much when you look at the country in aggregate, but when you disaggregate data and look at each and every regions, you will notice that some regional markets are already recovering quite significantly. Therefore, we are getting closer and closer to the point where our credit mechanism should slowly be repaired and credit would function again through the US economy. So why unlimited QE, as was announced last week? That's a big puzzle. One of our secular theme actually has been asset price targeting by central banks. And I increasingly believe that we're getting there. The US central bank is changing the focus of its mandate from price stability to employment levels. And they have very clearly stated that they will expand the balance sheet of the central bank as long as the employment level in the United States is not satisfactory. Please remind that in the US, there is still significant demographic growth. So just to absorb the growing pool of labor available, it takes much more job creation than in a place such as Europe or, of course, Japan, which is the worst demographic by a long shot. For allocation and for markets, it is a major game changer. So we're going to have some of those in coming months. We have new bouts of volatilities driven by new factors. But I think for the immediate future, it will give a very strong confidence to investors that risk assets are safely bid by the central authority, you know.
Yves, thank you very much for this rather unexpected viewpoint.
My pleasure.
Well, thanks so much for those great insights. That's all we've got time for right now, but stay tuned to Dukascopy TV for more updates and interviews. For now, though, goodbye.